Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from Pillar 2 to recent developments in U.S. tax policy. I'm Doug McConey, PwC's International Tax Services Global Leader. You can watch these podcasts on YouTube at youtube.com/Doug McConey. On this week's episode of Cross-Border Tax Talks, we're back in PwC's Policy on Demand studio in Washington, D.C., where I'm excited to have Ninee Dewar back on the podcast. Ninee is an international tax partner in PwC's Washington National Tax Services Group. Ninee, welcome back to the podcast.
Thank you. Great to be back.
So Ninee, it was way back in August of 2020, deep in the throes of the COVID lockdown, where you joined this podcast virtually to discuss FDII or FDII. I'm still not sure that we've decided on what to call that.
Yeah, I think I've come around to FDII now.
I'm a FDII. All right, good. I'm a FDII guy. So first of all, it's great to have you in the studio, but we're deep in winter now in early 2023, a year and a half after our previous episode. Before we begin, what's one thing you miss about your lockdown experience?
Ooh, I'm not sure there's a lot I miss, but
Yes.
I guess the easy access to the kitchen to get my snacks and tea and coffee, that I miss.
Nice. I think I have not been quite as diligent with my exercise now that I'm back on the road as much as I am. And I miss being able to take that quick break to head down to the basement to get a little bit of exercise in. And I need to work on that. That's going to be one of my New Year's resolutions, I think, for 2023.
That's a good one. Yeah.
All right, so let's dive into the FTC regulations, Ninee, because there's a lot to discuss. So before we get to the recently proposed regulations from November of 2022, let's start with the final regulations that were issued in January of 2022, earlier that same year. Now, many of us refer to these regulations as the 2021 final regulations, since that's when they were first released, but they were technically published in 2022, so hopefully we won't confuse listeners. We did dedicate an entire podcast to those regulations with Wade Sutton. I'd encourage listeners to go back to that if they want to hear about that myriad of issues. But before we begin, can you give us just a brief overview of those 2021 final regulations and maybe some highlights or lowlights as far as why they were so controversial?
Sure. So the 2021 REGS is a part of sort of the series of foreign tax credit regulations that came out after the TCJA. So we had a big package back in 2020 to deal with the changes from the TCJA. At that time in 2020, they issued a proposed REGS, which became the 2021, I'm calling it 2021, final REGS.
Yep.
And the biggest sort of comments that the government got was around the introduction of the jurisdictional nexus, or what we know as attribution rules now. But despite the comments, the final REGS came out in December last year. And the biggest sort of provision that got talked a lot about is the creditability issue. So whether a foreign tax is creditable for U.S. tax purposes. There are other areas in there as well that maybe get a little bit less of a spotlight, including the disallowed taxes under Section 245 Cap A, DRD, and like that one. Even that one has some sort of unexpected sort of consequences that people don't think a lot about, and the allocation and apportionment of taxes dealing specifically with disregarded payments. So that's kind of what we got in for the final REGS. So since then, I think the government got a lot of feedback and comments around how challenging it is in terms of applying the new creditability rules when we have had the regulations covering this area for decades and decades.
Right.
And so it's a massive change without any changes in the statutory language, really.
Yeah, I think that's really the key piece, is that those 2021 final regulations where they had the jurisdictional nexus was the terminology I think used in those initially proposed regs, and then the final regs had this cost recovery analysis, which I think many of us thought were really significantly different than the proposed regs. And I think the challenge that I know you and I've struggled with on a number of different fact patterns is that when you started to analyze non-US taxes, and even just starting with income taxes before we even got to withholding taxes, for example, kind of the more you looked at it and the more closely you looked, you realized just the number of really big differences that non-US law has with US law, specifically with respect to cost recovery and these expenses. And I think it gave many of us significant concerns where, you know, some of these corporate income taxes, like, well, are those really creditable under this new standard? And specifically from some of our major trading partners, like, I think that many of us were like, well, this can't be what they intended, right? For some of these, like, just basic corporate income taxes from some of our big trading partners, like, well, that still has to be creditable. And so I think the guidance that we got from Treasury with respect to these proposed regs were specifically were very much welcome from taxpayers and advisors alike. All right, so the new proposed regs, as you mentioned, really cover, amongst other things, the cost recovery requirement, the attribution requirement for withholding taxes on royalty payments, and then this definition of reattribution asset for purposes of allocating and apportion foreign taxes. And I think we're going to spend most of our time covering those first two topics. So let's start with the cost recovery requirement. What changed there in the proposed regulations?
Yeah, so the final regulations require that significant costs and expenses be recovered, and so they also have the per se list, so lists of costs and expense that are considered, you know, significant, including, you know, capital expenditures, interest, rents, and royalties and things like that. The challenge there is because all the cost has to be recovered. If you have a little bit of items that are not recovered, and it begs the question of, you know, it's a cliff effect. Like,
right.
Do we lose it altogether? Now, the final regs have an exception or an out to this, you know, all the costs being recovered being a principle-based exception. So if you find some disallowance or add backs under foreign law that is consistent with U.S. principles disallowing similar types of expense, then it could still meet the cost recovery requirement.
Right, that's the principle-based exception.
Yes.
Right.
So the proposed regulations are really helpful in this area and are very welcome in that they change from sort of all significant costs have to be recovered to substantially all of each item have to be recovered. So that is still subjective. The regs don't define what it means by substantially all, but at least there's an avenue to kind of go and analyze it. And probably even more importantly, there is a safe harbor that is introduced in the proposed regs now that allows for, and there can be kind of two types of safe harbor. Mm-hmm. One is if the deduction is limited to a certain percentage of the expense or item, if that is not more than 25%, then you can still be considered to meet the safe harbor and meet the cost recovery requirement. The other one is around if the limitation is based on the expense being capped to a certain percentage of either gross receipt or gross income type, that's limited to 15%. So as long as it's more than 15%, you're good. Or
from a gross income perspective.
Right, from a gross income perspective. Or if the test under local law is not on gross income, but more so based on taxable income, that percentage is 30%. And I think this is the area where the Treasury also is trying to be sort of more open, because they add the language like gross income or similar measures, or taxable income or similar measures, which means that, like, if you find yourself in the local law that maybe has some rules that are not exactly taxable income, maybe it's book income or something, you can maybe still find yourself satisfying the requirements.
Yeah, I will note that this new sub-all requirement will just add this to the list of various areas of the tax law where we have a substantially all requirement, but not a lot of guidance on exactly what substantially all means. But I think that the fact that they did give some of these specific safe harbors are welcome. I'll also note that they included some examples in the regulations, kind of applying these safe harbors. I think one was for a 25% disallowance for royalties for patents. One was a 25% of interest, and another one was an interest at 30% of taxable income. And I think many of these are fairly common, particularly as we think about the EU and some of the limitations that they have specifically on interest. This gives us a lot more certainty with respect to those particularly corporate income taxes and being able to meet the safe harbors.
Yeah, and I think the way people would analyze the rules going forward now, you would sort of start with the safe harbor because that's the most, subjective thing. Go to safe harbor. If you can't meet the safe harbor, then go to the principle base because the proposed regs maintain the principle based exception with some clarification and examples to your point. So it's only after you cannot satisfy the safe harbor or the principle based exception, then you would go back to the sort of substantially all analysis. So I think that's helpful.
Absolutely. It gives us some sort of clear lines because I think that was really where taxpayers and advisors were struggling, is that it was supposed to be a cliff effect, but we just didn't think that was intended. And now I agree with the approach insofar as let's start with those safe harbors, let's start with some of the examples, and I think that answers a lot of questions, but there are still certainly a whole number of different tax systems out there where the square peg does not fit within that round hole.
Right. So I think this is the area where if taxpayers still find themselves with some question mark issues, like put in comments so that the government maybe can add additional examples that will help clarify certain regimes.
Yeah, great point, because the important thing to remember, and we said this, these are proposed regs. And
Yep.
so it feels a little kind of backwards because we're addressing some of these issues with the final regs, but it's really important. These are proposed regs, and I think it's really important for taxpayers. There's an opportunity to comment on this.
Absolutely.
And maybe even add additional examples or additional guidance to give taxpayers more certainty. So the examples from the cost recovery method, the safe harbors, related to the safe harbors, I think were very helpful, Ninee. But one of the other things that I think was also welcome was they added 2 examples with respect to the principle-based exception. Tell us a little bit about the principle-based exception and kind of what color we can gather from those examples.
Yeah, so I think those are helpful. Like one example in particular is around anti-base erosion. The other one is about stock-based compensation. So they point right to non-tax, policy. And I think what I take away from that is the examples kind of jump to how do we tie it to the U.S. principle without really analyzing deeply on what is the intent or policy behind the local law, which is kind of what we struggle a lot when we were doing the analysis since the final regs came out to try to understand what the purpose of these add-backs or disallowances are. And a lot of countries don't have a good system to track their legislative history or reg history.
Right, to know why.
To know why the provisions are what they are, and it kind of, we can kind of guess what they are, but we don't have anything to point to. So I think the regs are kind of helpful because it's sort of hinting that maybe you don't need to really go deep. If you have that, that's great, but maybe you don't need to go deep.
Yeah, and I mean, it's challenging as you look at every single jurisdiction, right, as we're thinking about creditability. It was quite an undertaking that I know that a number of us have gone through, and I know taxpayers and other advisors have gone through to try to do the analysis. I will specifically mention kind of that example 9 in those final regs and you already mentioned this, is that it says if there's no deductions for payment if it's not subject to tax. And so similar to our 267 Cap A, but obviously a number of jurisdictions that have those rules, and I think will be implementing those rules, particularly as we think about the subject to tax rule with Pillar 2, that could have created uncertainty. And I have a feeling that taxpayers may advocate for even more examples when it comes to this principle-based exception to help provide additional clarity for taxpayers.
Absolutely, yeah. There's so, I learned more about foreign tax law system than I would really like to admit.
Yeah, no, absolutely. And what a challenge it's been, particularly as we've engaged with our non-U.S. colleagues to try to understand their tax systems. And then you would ask, well, why is this law come into play? And they're like, why do you want to know why the law came into play? Here's what the law is. And yeah, I felt like we were sometimes talking in circles as we were doing that analysis. And I think hopefully this will make things a little bit more streamlined.
Yeah.
All right, so let's move to the attribution requirement. So, because I think this is another one of the big changes, because the 2021 final regs require withholding taxes to satisfy a source-based attribution requirement similar to the U.S. rules. So maybe even before we dive into how those rules change, can you remind listeners, because this was a big change, that for withholding taxes specifically, what did those 2021 final regulations do?
Yeah, so the final regulations call for the withholding tax to satisfy, to become creditable. One of the conditions is it has to have a source-based attribution. And typically attribution rules can be satisfied via, situs activities or source, but for withholding tax in particular, it's source-based. And what that means is the foreign law to source the income that is subject to withholding tax has to be similar to U.S. law. So if you think about royalty, then you need to look to the sourcing of royalty rules in the U.S., which is based on place of use or right to use IP. And so after the regs came out, we survey a lot of countries to try to understand what their rules are, and we find out that majority of the countries actually don't follow the rules that we follow. So a lot of them impose withholding tax based on place residence, basically.
Yeah, based on the payor. And I think the other one, in addition to royalties, was also services, right? So the U.S. rules are based on where those services performed. But many, I think, non-U.S. jurisdictions will just, similar to royalties, will base the withholding tax based on who's making the payment, as opposed to necessarily where those royalties or where those services are performed.
Exactly, and these are, the analysis has to be done based on what the law says. So like facts don't matter at the time for the final regs. So like you could use IP in country, or you can perform service in country, as long as the law doesn't really say that, then you're not satisfying the rules.
Right. And I think, you have to look at every country specifically to see how those rules are structured in the payor. But I think that generally speaking, Latin America, a lot of those countries base their withholding taxes on the residence of the payor as opposed to where the IP, although I think there were other examples that we saw throughout the rest of the world, frankly, that had similar rules. So that was, I think, a very big challenge for taxpayers, and particularly for those that had IP sitting in the U.S. and they were attracting big royalty payments. There was a question of, do those withholding taxes, are those creditable taxes, as whether 901 or 903 taxes? So what changed then, Ninee, in the proposed regs that I think gave many of us a welcome change?
Yeah, so the highly anticipated change is around sort of some relaxation on the rules. So Treasury and the IRS basically allows an alternative to satisfying the source-based attribution through the so-called single country license. So basically, if the payment is for royalty and the withholding tax is imposed and the royalty is made pursuant to the single country license, and I'll come back to like how you satisfy that, but if you fall within that regime, you can be considered to satisfy the source-based attribution, and therefore you can potentially get the withholding tax to be creditable. There are still other prongs of the withholding tax testing that you have to do, but at least on the attribution side of things, if you satisfy the single country license.
Yeah, so as long as it's a royalty under foreign law, you satisfy the single country, and then it can't be treated as a sale for U.S. purposes, then you end up in these new rules. So let's start with let's then move to what is a single country license? Because I think this is a lot of taxpayers are going to have to look at their license agreements and really spend some time understanding whether they meet this new definition.
Yeah, so the regs provide for two ways to satisfy the single country license. One is the terms of the license agreement have to say that the payment is for royalty and specifically state that the IP is used in that particular jurisdiction that imposes the tax. So in a way, this is probably applicable to a lot of taxpayers where they have just a single country license. The US may be licensing to Brazil, and that was it. So you might be able to come under that. If you don't have that, there's another alternative to satisfying it, which is, again, you have to have the agreement saying that the payment the license is for royalty, and instead of specifically saying the country that it's covered, as long as it states the portion of the royalty that relates or is attributable to the use in country, in that particular country, then you can satisfy the single country license. Now that's kind of the formal side of things, right? The requirement that these are stated in the agreement. There is sort of the substantive requirement as well, the so-called like validity requirement. So taxpayers have to not know or have reasons to know that the agreement misstates the territory that is covered or overstates the amount of royalty that is attributable to whatever portion you're claiming. And that has to be done under US like Section 482 and 861 principles, which means that you kind of have to think about a lot of these sort of multi-country license where you need to like allocate the portion relating to a particular country. It has to be under, U.S. tax principles, 482 and 861. And when you think of, when I think about the practical application of this, is some people might not have done the work, so like this is the additional things that they need to maybe try to do in addition to like making sure that the agreement says the right things.
Right.
Substantively, they need to be able to kind of support the portion. And on top of that, there might be some transactions that is disregarded transaction where these 482 analysis is never relevant, or it could be a foreign to foreign license transaction that, we didn't really care too much about 482, and now you need to make sure it's aligned.
Yeah, great point. So maybe a couple things to play that back. I think the first is it feels to me that maybe the course of least resistance is to try to get to that single country license, right, as opposed to having to identify, and we'll come back to kind of what the appropriate 482 amount is relevant for a particular jurisdiction. But to the extent that you can do a single country license, I feel like that's kind of the course of least resistance. But I do think it's not uncommon for companies to have kind of regional type of licensing agreements, whether it's from the U.S. or a regional headquartered company or whatever the case may be. So companies and taxpayers will need to focus on that.
And just on that one, it can get even more complicated too, Doc, because it could be like a license to a manufacturer that manufactures products in country, but then distributes the products around the world. So you have to think about how you determine where the use of IP is, if it's a manufacturing IP versus distribution rights IP, right?
Great point.
And we don't really know. Like, I think we read the rules. This is the area where the REGS sort of suggests that you would have to analyze where the IP is used or attributable to the country under U.S. principles. So, like, we have to go back to our U.S. rules of, how do you determine place of use for various types of IP? And we have a long list of case laws to kind of go through.
No, great point. So really important to consider that. As we think about the kind of the 482 piece and trying to, as this kind of alternative way to meet the single country license requirement, that you're right. I think in many jurisdictions there are limitations based on the deductibility of royalties, for example, and so that there maybe hasn't been the need to be able to or desire to do the full 482 analysis. And so I think that can complicate things. The other example that you gave that resonated is, if these are disregarded entities sitting underneath the U.S. and you've got royalty payments coming from a disregarded entity, all that income kind of flows through. probably hasn't been a whole lot of analysis other than from a foreign law, non-US law perspective of why you would even look at that analysis. And this could require taxpayers then to have to do a 482 analysis on a disregarded payment, which again, I think lends you to more of the just trying to focus on the jurisdiction as opposed to having to do the 482 analysis. But so remind me, when is that documentation required? And because how much time do taxpayers have to actually get their documentation in order to credit this, particularly given the fact that these go, date back to 2021 when these final regulations were issued?
Yeah, so the general rule is you have to have the required agreement with appropriate language and all of that in place before the payment is made. So that's great for going forward. You can try to do that, right? But luckily, we got the transition rule, which essentially allows taxpayer to apply the rules to past payment as long as the required documentation is in place by May 17 of 2023. So taxpayers do have a little bit of time to do all these studies and analysis that they have to do to get the agreement in place.
So May 17th, 2023, taxpayers, advisors, take note. You need to have those royalty agreements kind of fixed to avoid those historic withholding tax payments since the final regs were issued from potentially being non-creditable. All right, so let's move then, because there's a lot there, to the allocating and apportioning foreign taxes. Now, we could spend a lot of time on this, but maybe, Ninee, if you just want to give us kind of the highlights here with respect to the changes to the reattribution asset rule, specifically for disregarded payments.
Yeah, I mean, this is the portion of the regs that I think is very dense. And
very
I practice
dense
in this area, right? So I spend a lot of time on it, but every time I read through it, it's like, oh boy. This particular rule in the proposed regs kind of deals with the disregarded payment in where we would have to reattribute the assets because there are disregarded transactions between entities. And generally, you would have to reattribute the assets of the payor to the payee. And so the rules basically are specific to a transfer of property. And like people tend to think about inventory as sort of the leading item, where you might have a manufacturing disregarded entity that sells products to disregarded distribution company or disregarded entity. And so there's a movement of the inventory, and typically because there's that purchase going on, we have to reattribute the assets of the relevant entities. So the rules basically said for transfer of property, you don't do that. And the reason this is relevant is when you look at like a remittance rule where maybe a disregarded entity makes a dividend distribution to its owner, you have to look at the assets of the distributing company, and this is why which assets sit in which entity makes a difference, because it could mean the tax is allocated to a passive basket because you have cash sitting there, or if you have inventory, it could go to guilty basket and all of that. That's why it's relevant. And so what the rules are doing is to try to make sure that you don't reallocate that assets. Now, I think this is the area where it could be really helpful for some taxpayers, and it could maybe not produce the result that taxpayers are really happy with. So you kind of have to go through and look at whether you want to early adopt the rules, because this is proposed regs, right? And so this is an area where it will become rules when the final regs are finalized. But in the meantime, this is where taxpayers can maybe think about whether to early adopt or not.
Right, and this has been a common theme, right, since the TCJA, and particularly where you have where taxpayers have the opportunity to adopt proposed regs earlier. Anytime there's election, you got to do the modeling. And I think you're right that one of the things that we've learned as we've looked at some of these rules related to disregarded payments is that the analysis may not always be intuitive, because you have to look at those underlying assets to be able to determine whether it should be guilty basket or passive basket or any of the other groupings for the basketing. All right, so effective dates. And so there were kind of a myriad of effective dates. We already talked about one of the important pieces related to withholding taxes and getting documents executed by May 17th, 2023. You mentioned that for this reattribution asset rule for disregarded payments, that the taxpayers have the opportunity to early adopt, but these are proposed regs kind of sitting on top of the final regs. So how do the effective dates generally work for this?
Yeah, so these three buckets of sort of provisions within the proposed regs, they all allow taxpayers to early adopt, essentially, as long as you apply it consistently. Now, they make it very clear that these are three distinct provisions. So when they say apply consistently, you can kind of early adopt some, but not the other, because they're separate. So you could apply cost recovery and maybe withholding tax attribution rule early, but maybe you might choose to, not early adopt the allocation and apportionment of tax rules.
And I think that's very helpful, obviously, for taxpayers.
Yeah, definitely. So for the cost recovery and withholding tax, that can go back to, since the final regs came out. And for the disregarded payment, the attribution, the allocation of the taxes, that can go back to when the rules relating to these are finalized. So like after 2019, you can apply these rules.
Yeah, and I would suspect for most taxpayers, looking at the royalty withholding tax rule as well as the cost recovery, most taxpayers are going to want to go back and apply those rules retroactively.
Yeah.
All right, so maybe in closing here, Ninee, what advice do you have for taxpayers? I mean, there's obviously a lot of complexities, some welcome changes in the proposed rules, but what do you suggest for taxpayers and advisors here in the immediate term?
So I think a few things. On the cost recovery, go back and revisit some of the taxes, right? Because these rules are helpful. So some of the taxes that are questionable, German trade tax, Mexican corporate income tax, and other things, like go back and revisit those to see if the proposed regs are helpful. Mm-hmm. On the withholding tax on royalty, again, go review the license agreement, see whether changes can be made to get into the rules. Mm-hmm. So I think those two, are really helpful. And then on the attribution, asset attribution, I think just, modeling out how it impacts. And then probably important point to raise is Treasury is still looking for comments and feedback. So, to the extent you find yourself in one-off or weird situations that the rules don't quite work the way they should, then, reach out, submit comments.
Yeah, I think that is an important message, and that, we got those final regs at the beginning of 2022, the 2021 final regs, and I think many of us were concerned, well, will Treasury go back and relook at this? And obviously they have, which I think is very welcome. And the fact that these are proposed regs, it gives us, as taxpayers and advisors, the opportunity to provide even more comments. And I can imagine maybe some additional specific examples and, frankly, a number of other technical issues, I think, related to services, for example, similar to the royalty issue, caused a lot of issues for taxpayers. And so I think at least it does give taxpayers the opportunity to provide comments, and they should take advantage of that during this notice and comment period. All right. Well, Ninee, thanks for joining. Really appreciate it. Always good talking to you. And then we'll get some final regs on this too, and we'll have you back to see hopefully the final regulations more closely aligned to these proposed regulations than on the last go.
Yep.
So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Ninee Dewar, International Tax Partner in PwC's Washington National Tax Services practice. I'm Doug McConey, PwC's International Tax Services Global Leader. Stay tuned in 2 weeks for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.